So we know that the Federal Reserve does not reduce interest rates when things are good. Okay. The Fed is so much as admitted recently that this next rate cut, which is going to come next Wednesday, I believe it's the 29th, is going to be implemented because the labor market in this country, the jobs market, is in a shambles. Okay. And on top of that, the Fed now has what it believes was benign inflation numbers, if you believe that, right, from last week. So all signs are a go that we're going to get another rate cut, probably a quarter point on Wednesday. This is going to further foster a catastrophic environment as it ties back into these non-depository financial institution loans we've been discussing for about the last week on the channel now. And so I want to bring it full circle today and explain why we're going to tie in how it's going to impact, or why the smaller banks, are the most vulnerable. I didn't discuss that yesterday. I covered the big banks. We're going to cover the smaller banks today briefly. So look, when the Fed cuts rates, what happens when these NDFIs are out there looking for deals? Lower rates allows their cost of capital to come down, okay? So they can scale up, which is what they want to do, their loan originations, especially in the riskier credit segments that we've been talking about with these NDFIs. So they're all, lower rates, as you understand, forces investors, lenders to, you often hear this, reach for yield. And of course, these banks chase yield through indirect lending, okay? Because as traditional loan margins compress, banks look for higher yield assets. Lending to NDFIs, right, who then lend out that money to consumers, we're talking about that in a second, small businesses or real estate developers, becomes very attractive. So the FDIC, I'm going to cover this with you in a second. FDIC issued a credit risk report just a few months ago. It was in May of 2025, and then they updated it in June of this year, okay? And they specifically, you can pull that report for yourself, okay? They specifically detail the risk presented by these NDFIs, all right? And on yesterday's show, I shared with you that the new reporting regulations put into place effective January of this year. Any bank over $10 billion is considered a large bank. They have to now report granular breakdown of their NDFI loans and exposures per category. There's 5 categories. If you didn't see yesterday's show, go back and look at it. It breaks down the 5 categories and how much exposure the large banks have. Let's talk for a second about all the banks in the United States that do not have $10 billion in assets, okay? Because again, the Fed's going to be lowering rates, especially these smaller banks and mid-sized banks are going to be reaching for more deals. The deals are presenting themselves with these NDFI loans, okay? And that's putting, I believe, systemic risk into the system, okay? Quickly, I pulled from chat. As of Q1 of this year, there were approximately 4,462 FDIC insured commercial banks and savings institutions. 90%, okay, of those, meaning total assets under $10 billion, okay, of that number, okay, 90% have assets less than $10 billion, making them, let's say, not a big bank, a regional, smaller size bank, okay? So 90% of the U.S. Banks in this country are commercial banks, which correspond to smaller asset size. Why is that important? Before I jump into it, as I always humbly ask, please subscribe to the channel if you're not subscribed. And to all the new subscribers coming over the last week or so, I appreciate all of you being here and watching. So why is it important that we understand that 90% of the banks are not in the category of banks that need to report specifics about their NDFI transactions. Okay. Um, and that's important because they don't need to break it down. So I got some comments yesterday in the video. What about the smaller banks? They're exempt from what I'm seeing. The research shows that the smaller banks, okay, under 10 billion, are pretty much exempt. They still have to do, quarterly reports, and is supposed to be in those quarterly reports, but not broken down. So it's extremely difficult, okay, to track that. All right. So in this 2025 risk review from Fdic, okay, it's many pages long. One of the categories deals with these NDFIs, all right? And it says basically that, let me pull up this page I want to cover with you guys. Loans originated outside of the banking system are not subject to the same safety and soundness standards as bank loans, which could lead to higher risk lending across the financial system. NDFI's vulnerabilities could also pose direct credit risk to banks. And banks may also, or bank capital, it says, may also be at risk from some NDFI loans being structured at origination to achieve lower asset risk weighting. So we have a lot of it. And go back and pull this risk analysis for yourself and take a look at it. It's very detailed, a lot of charts. I can't cover it, in one show. But the FDIC, again, it is on their radar. Okay, so as we start to see the Fed continue to lower rates, right, to address a failing economy, we're also going to see, okay, at the same time, okay, an increase in these types of, these NDFI transactions. Excuse me, and understand, as I covered yesterday, a lot of these loans, as I just said, are made to consumers. Okay, well, what is the status of the consumer in this country? Look at what's happening with auto loans. Look what's happening with these used car dealerships, okay, and the auto parts places. What is happening with consumer debt in this country? What's happening with the student loans in this country? The consumers are in very, very bad shape. So where is this going to start? Maybe it does start. Maybe the collapse starts with the consumer, NDFI transactions and spills over, okay? But it's going to happen. The Fed is creating an environment, from my perspective, I'll love to get your thoughts and comments, is creating an environment where this is going to be a powder keg when this thing, tips off, okay? And that's really the reason for the thumbnail for today's show. Because I just don't see the Fed reversing course anytime soon. Look at the national debt, the U.S. debt, federal debt's 7 trillion now. So I mean, they need to keep rates low just to service their own debt. And so this is going to foster more malinvestment, more reaching for yield, more of these intermediary type lenders jumping in, trying to put together deals and lending to people, groups, consumers that have no business, borrowing. And frankly, if they could borrow from a traditional larger bank with traditional collateral, they would do it, okay? And they're not because they can't. Look what happened last week, with that Cantor group blowing up, and the exposure to Zions, the exposure to Western Alliance Bank. So the low-hanging fruit, like I said yesterday, will probably be where these things start to blow up. But it's going to act as contagion for all the other categories of loans, okay, that we talked about yesterday. I had breakfast with a friend of mine yesterday morning, actually, and he was formerly a VP of a local branch, actually under Zion, which is Cal Bank and Trust, the one that wrote down $50 million last week because of that blown deal with Cantor Group. And he had said that the call reports, that the bank's call reports, is now with a different bank. I won't name the name, but he can't even find anywhere in the call reports for his mid-sized bank where the NDFIs are listed. Okay, so he works for the organization and he can't find it. All right, so let that just sink in for a second. I do get some comments saying, well, what do we do? I don't think, this is my personal opinion, it's not financial advice. I'm not telling you what to do. I don't see this thing, blowing up overnight. I think as the Fed tries to keep a Band-Aid on the failing economy, it's going to put more bad stuff in the system. Okay, but it's also going to potentially, I'll get your thoughts and comments, give the consumers maybe a small lifeline to finish the job, right? To really seal the deal for themselves in debt, right? Because lower rates are not a good thing. Doesn't mean things are strong, but it also fosters bad financial decisions, not just by banks and investors, small businesses, but also mom and pop consumers that go out and overextend for the car, overextend, grabbing new credit cards to finance vacations and things of that nature. So I don't want to go too long today, but I want to wrap in because we covered the big banks yesterday on the Ndfi exposure. But look, there's thousands of regional banks and community banks across this country. Okay, so how do you protect yourself? Well, number one, from my perspective, don't have all your money in one place and in one institution. Spread it out. But also, you could consider as an alternative, having some sort of your let's say deposits in a larger bank institution. Maybe consider that as well. But I don't think, I saw some comments to one of my shows the other day that someone's going to run and take the money out of the bank and look, or sell everything. I'm not preaching for that. I'm not saying that. This thing, I don't think, from my perspective, is going to blow up overnight. You're going to see it little by little. You'll hear about one failed deal here, another Cantor group here, another bank gets hit for 50 million. 100 million, but I think what we're going to see is this start to accelerate, all right? And the lowering of the rates is going to compound the problem, all right? And it's going to make these intermediary, facilitators more greedy, okay, and more exposed, okay? And ultimately, I think it takes everything down. It's just too pervasive. I know that sounds, catastrophic. I'm not saying it's going to be tomorrow. But I think it originates here. And don't forget, a lot of the AI startups are also funded through the NDFIs, okay? And that's going to be another shoe to drop, right, or a bubble to burst probably in the not too distant future. And I'm not saying it AI in general. We have so many zombie AI startup companies out there as well getting funding, right, that never make a dollar, okay? So, if you guys enjoyed the content, leave me a like on the video. Subscribe to the channel if you're not subscribed. And I always ask for your comments and your thoughts. I do my best to read them and respond to them. And with that being said, I will talk to all of you soon. Bye.